scholarships all along the way.
Thank you very much.
Thanks, appreciate it.
I'm going to kick it off just by saying hello, and Huey and I are both very pleased to be here. How many people in this room knew that the College of Business Administration had an economics major? Huey and I were two of 20 people in our year that graduated with econ majors, which made Dr. Sanford Berg extraordinarily proud because Huey's first job was extremely high paying, and it totally skewed the results of the pay that each of the majors received. Being in fact, let's just get down to who we are, and then Huey can get down to what he does, and then I'll talk about what I do. Introduction. Huey Richardson graduated from University of Florida's College of Business Administration with a BS BA in economics. He played football for the Florida Gators. During this time, he was named first team 1990 All-America team and two-time first team All-SEC selection. He is squirming so hard right now. He was inducted into the SEC Hall of Fame in December 2001 and the University of Florida Athletic Hall of Fame in April 2003. It's interesting that Florida had to see the SEC do it first, don't you think? They could have come up with that one on their own. He was an academic All-SEC honor roll selection in 1987, 1988, 1989, and 1990. The only reason he wasn't in 1991 is he only took one class. Huey was a first-round draft pick of the Pittsburgh Steelers in the 1991 NFL Draft and spent several years in the NFL. After leaving the NFL, Mr. Richardson went back to school. I wrote this, by the way, and received his MBA from Emory University's Goizueta School of Business. He is currently employed by Merrill Lynch in their Global Equity Financing and Services Group. Now, I used this picture last time, but it wasn't quite as big. They all have these slides. It's fantastic. They all knew this was coming, and you didn't. Liam O'Neill graduated from the same school with the same degree. He was a danger to himself and the people around him while at UF, and has no particular skills of any kind. Despite the above, he was a first-round draft pick at SunTrust Banks in the 1990 draft. After 4 years at SunTrust, Mr. O'Neill went back to school and got his MBA from a school that had questionable admittance practices at the time. He also works at Merrill. Like Mr. Richardson, Mr. O'Neill does not like to be photographed, so you won't see a picture. Unlike Mr. Richardson, Mr. O'Neill is proficient in PowerPoint. It is entirely likely that Mr. O'Neill will sustain significant physical injury as a result of the poetic license taken during the course of this presentation. That whole motto of pick on someone your own size, foolhardy. Now, in all seriousness, we're very, very happy to be here because we're very, very impressed by the program that Dr. Brown has built. And we're very, very impressed with what University of Florida has become. Quite frankly, I'm not sure I could get in here again. It was hard enough the first time. And so you all should be very proud of the program that you're a part of. And in large part, what you'll hear from me after Huey speaks is kind of what I wish somebody had told me about finance when I was in undergraduate, because I had no idea what I wanted to do. And my goal in every interview was just to conceal that fact as much as possible. Huey has spent a significant amount of time in our cash equity business at Merrill Lynch and has as good a feel, I mean, given that he's run a booth at the New York Stock Exchange and works in equity financing, which is a staple of the hedge fund industry, he can give you a pretty good idea of what's going on in the cash markets. And then I'm going to talk to you about derivatives. So with that, Mr. Richardson.
Yes, thank you. Half the stuff he said was probably true, and the other half of it he doesn't remember anyway, so take it as what it's worth. I guess I'm going to start off what I've, after grad school, started with Merrill Lynch in the cash market, cash equity market, and basically want to take you from where I came into that into where it is now. I'm assuming most of you guys are familiar with the buy-side, sell-side, and obviously Merrill Lynch, although we do have a buy-side operation, you know, for the most part, when it comes to institutional investing, we are a sell-side shop. Well, I guess show of hand, are you guys familiar when I say buy-side, sell-side, or okay? I'll start with a little small diagram here and tell you how prolific this change has been because of the electronics. And if my handwriting is too bad for you back in the back, I apologize. Through the years, obviously, with investors needing to have avenues to invest, you start with your PM on the buy side. You have a research analyst and then a buy side trader. The way the sell side was getting into these guys, basically we would start off with, I guess we would have our research analysts as well. Then you have research sales. Then you would have a sales trader, and then finally you would have a trader, a sell side trader. In regard to, I guess, going from getting the information that we had on the sell side, there were so many conduits going over here. Research analyst was talking to this guy was talking, these two were communicating, these guys were communicating. That model pretty much broke down with the advent of computers, I guess. Well, we just jump right to it. When I first started with Merrill Lynch, particularly in my position, on the floor of the exchange, we probably had 130, 140 guys just in the position I had alone. That's not counting the floor brokers. Within 7 years, I just left that industry about a year ago. Well, that part of the business a year ago. We now have 4 or 5 guys down there. Huge change. And this was all driven by the research that the sell side was being able to provide to the buy side. The high-touch model, basically, for it to be successful, the buy-side people had to be willing to pay for the research salesman, and I'm not even going to get into the trading part until a little later on. But the emphasis was basically placed on research. Now then, this is a product that the buy side with these guys here could produce themselves, and they did quite well. For us to be able to generate all these trades, I guess the information flow went from the research analyst to the PM. He would send it down to the buy side trader. The trader said, okay, fine, I want to buy this stuff. This trader here would then come over here to the universe of the New York Stock Exchange where I was. Let's see. And we would execute a trade within probably 13 minutes was our target time of when this guy gave this guy the permission to trade. The buy-side community now expects, and again, it's not an issue of what is better. It's not a question of what's better. It's a matter of what the customer wants. They're expecting their trades to be performed within 30, 40 seconds max. They want executions to hit as quickly as possible. So now there's no way that you could physically get all this information here, go through here, this trader get the information to me as a broker on the floor of the exchange and get executed within 40 seconds. By the time it gets to us on the exchange, we actually expected to have it done within 7 or 8 minutes. All this generated, like I said, commission fees, which when I first came into the industry, I think commission fees were about 24 cents for every share traded, to now it is 2 cents. Actually, it's below a penny was where they're going now for each trade. And forgive me for I'm bouncing all over the place here, but the advent of the computer basically has eliminated the need for anything that goes on over here, which is where I was. I just lost my train of thought. Excuse me. As I said, the computer steps in. It basically takes the time that the buy side can get their executions down from about 13 minutes to about 6 seconds or whatever. The worst part for us on the exchange was the value that we were adding in regard to when you want to execute an order. You know, computers have come far as artificial intelligence, but they cannot discern information. For instance, if sometimes you hear about these aberrations as far as a trade that happens that takes the entire floor offline. Where there are a couple of stories where some guys at Lehman Brothers, when they were placing orders in, they put the notional value in as opposed to the number of shares that they were trying to sell, and so all of a sudden these guys would get these orders, sell 1 million shares, or they would get a basket, sell 1 million shares of this, and this. Now, if you execute something like that, sometimes you will create a spike in the market. And when that happens, all chaos breaks loose, and people wonder, well, why did that take place? Well, that's because someone wasn't smart enough to look at that and make a decision on how this should work. This is now taking place sometimes in the electronic market. Excuse me, I'm a little warm. Taking place in the electronic market because a computer cannot discern between, I need to sell 1 million shares of X, Y, and Z versus I need to sell 1 million shares of X, Y, and Y. So it would send the order out automatically. Does not recognize, well, if I do this, I am going to create a gap in a bid-ask spread and end up causing some people to adversely affect the market for what they were trying to do at the time. And if there are any questions, please stop me.
As a sure. Huey, thinking back to that old model.
Yeah.
As a former Lehman guy.
As a non-Merrill Lynch person. Did you at any part of your career on the floor of New York ever think you were value added because you looked another floor trader in the eye, because you knew him and you saw him every day? You knew, even though he was standing in the crowd saying he was a seller of 50,000 shares of Hewlett Packard, that because of the way his right eye was twitching or his fist was clenching, that you knew or suspected that he was really a seller of 6 million?
Yes.
That today, it's maybe more difficult to discern?
Today is definitely more difficult to discern. And what he's speaking of is trading is not really a science, it's more of an art. And if you walk into a crowd sometimes and you walk in, you want to buy 50,000 shares of IBM, for instance, and let's say Liam has 1 million shares to go. When would I want to buy his 50,000 shares? Well, buy my 50,000 shares of his 1 million shares. I wouldn't want to do it on the first 50,000. I like to do it after he sold 950,000 shares and he just has 50,000 more to buy. Now then, if you're worth your salt on the floor of the exchange, you can kind of feel these things out. Now, if you just walk into a crowd blindly, which no one generally does, is what you're basically doing with the electronic computers, you can sometimes get blindsided. But for the most part, there are plenty of times where the opportunity to add value for your customer, for your client, the PM says, I want to buy 1 million shares of IBM, or I want to buy 50,000 shares of IBM. We can get back on the phone and say, look, now is not the time. We got a seller out here. He's going to put pressure on the stock. The stock's going to probably come in maybe 75 cents. We can get it for you cheaper. Most of the PMs appreciate that, but what they did not appreciate was the cost in regard to how much it was costing them to execute their orders. And granted, there is value added in how much money we can save them by buying that last 50,000 shares of Liam's. But if my commissions on that 50,000 shares is 24 cents, I mean, right now we've got PMs that are telling us, I've got a computer model that I'm running that can execute my trades for me for less than a penny a share. Why do I need you to do this? And we did not. I personally don't believe we did a good job of selling what we do add in regard to value as a human looking at an order and as a computer looking at an order. And speaking of the algorithms, I'm sorry, go ahead.
Can you talk a little bit about that? So if you're trying to compare the human traders versus a robotic computer trader, is it fair to suppose the portfolio manager just says, okay, we're going to try to figure out whether you traders are doing a good job. So we're going to give, if we want to buy X shares, we're going to give half of those shares to the computer, and the computer will do whatever it does, which maybe means that it looks at average daily trading volume and trades, let's say, 10% of the trade per day over 2 weeks. And then the trader, they can do whatever they do in a very clever way, and then do that 500 times. And then if the human beats the computer, I mean, is that something that people do?
That is actually what was taking place when I first got down the floor exchange. And what you're talking about is VWAP trading and program trading for the most part. And yes, we quite often were put up against the tests. You know, there were times where the traders upstairs on a desk would actually have 10 million shares of a stock to buy or sell, and they would put 2 million shares down on the floor of the exchange. And then down on the floor of the exchange, we were out there executing the orders, but we keep getting this DOT, which is basically a quick order algorithm, or electronic trading platform that allows the computers to trade shares or buy or sell shares as it needs to. And it would turn out that we were actually competing against ourselves as a human traders against the computer machine. That's not to say that it didn't have it absolutely adds value, because if you need to get this done within a couple hours, or you sometimes it's difficult to, depending on the liquidity of the stock, it's difficult to buy 10 million shares in one day. Sometimes, depending on the stock, it could take 2 or 3 days if you're doing it as a human. But if you put it into the machine, it still can cause gaps in the program. But part of the problem, well, I shouldn't say part of the problem, some of this, I actually will call it problem. The PMs have what they have that are considered benchmarks if they're on the buy side. And if I am running a mutual fund for Fidelity or for the American funds, I've got to meet my target benchmark, whether that's the S&P 500 or the Morgan Stanley International Capital Index, whichever one I'm benching or marking myself to. And so what the PMs don't want to do is, okay, all of a sudden I'm buying all my shares. I'm buying all my shares, and I'm buying them at the high of the day, whereas this guy over here using his algorithm is using a VWAP program, and he basically just wants, VWAP stands for volume weighted average pricing. And if the price of the shares, the average price of the shares in one particular day was, let's say, $50, and I bought mine at $50.25, I'm already behind the curve on a relative basis to the other PMs. These algorithms have made their way over to the sell side as well, because we now recognize that if that's what the client wants, we need to see, well, we need to keep ourselves in business. I can remember probably about 5 years ago, a guy who's now an MD, I'm not going to say his name, on our trading desk. He's now one of the top 2 traders. He actually runs the desk. But I remember him saying that there were 2 guys in the back that Merrill brought in who had probably 4 or 5 computer screens in front of them. Looked like they were trying to run a NASA launch site over there. He says, I have no idea what those guys do. I don't know who they are. About a half year later, there's an entire back row of those guys. I don't know who those guys are, and I don't know what they do. Now I would say there are probably 3 or 4 rows of those guys, and the number of traders has gone the other way.
And your guy works for them.
Exactly, and my guy works for them, which now I, working for him, am no longer needed either, because those guys are using computers to do these things.
The interesting thing is, there's not a right answer per se, right? I mean, because if I'm marked against the close, if I have to be long, it's quarter end, and you were going to mark my performance based on the closing price of the stock. Well, I'm going to give you Merrill Lynch. I'm Fidelity. I'm going to give you a market on close order, and by the way, I'm buying a boatload of the stock. So you, Merrill Lynch, have to deliver me the closing price of the stock. So what you're going to do is you're going to buy it all day, and then at the end of the day, you're going to put in a gigantic order to buy. And the stock's going to go like this, and the stock's going to ramp. And because I'm Fidelity, you're actually going to share the profit that you're going to make on that execution by virtue of the fact that, well, I know how you did it, and we both know that you ramped the stock into the close. So you're going to share with me the economic profit. You're going to share with my fund shareholders, the economic profit associated with that. The other thing to be aware of, though, is even as computer-generated and driven as we are, I mean, I can distinctly remember a transaction where I was helping somebody hedge a position in a stock. They'd sold their company, and I had to sell short a whole lot of a stock, like 3 days volume, 3 or 4 days volume of a stock. And it was a NASDAQ stock. And I went over to our NASDAQ position trader. It was Bill Snedeker. And he knew all the buyers, right? So he knew that Fund A was a big buyer, Fund B, Fund C. So basically, he talked to the sales trader that covered them, and I was able to get the entire print off, the entire short sale off in one single print. I mean, 3 days volume, and that's kind of the value of a clearinghouse like Merrill. And this is not an advertisement for Merrill as much as it's an advertisement for there being no one single way that's right, because what portfolio managers are doing now, potentially, is being penny wise and pound foolish. Right? Steve Cohen, who runs one of the largest and most successful hedge funds in the world, is willing to pay plenty of cents per share to sell stock, right? Because he knows that everybody in the world knows that he's 12% of the average, 12% of the volume on the New York Stock Exchange, and so he's not a client you ever want to make angry, because if he goes away, it's a significant part of your book. But also, he wants information. He wants to know flows. He wants to be protected. I promise you, if you're 12% of the flow on the New York Stock Exchange, you're going to get protected, particularly if you're still willing to pay 6 or 8 cents a share. So it's the PMs that are kind of swapping the, yes, but I'm only paying 2 cents a share. Yes, but you're actually losing about 10 to 15 cents of economic value on every single transaction you do because you're getting a Walmart execution instead of a high-touch execution. I mean, anybody can trade blocks of GE, but when you get out of sort of that sort of mega cap stratosphere, there's a real art to trading stocks, and it can genuinely affect the way that your performance is in your fund. Yeah, the art is Billy Snedeker knowing everybody else who wanted to buy the stock, or the guys who are trading telecoms know that Fidelity's a buyer and American Funds is a seller. So in fact, instead of American Funds going to the dot machine or going to their computer terminal and trying to sell, 5 million shares of a thinly traded stock and having to put it in the machine and hopefully have a very sophisticated algorithm that will help them trade it, right? The guy who covers American Funds finds out that the trader has a position. His sell-side trader has a position in this stock that he knows that they're a buyer of, right? He doesn't know how much he's got to go, but he basically goes out to his client and says, hey, I think I found a seller in the stock you want to buy. Suddenly, 3 days volume can change hands in a single print at mid-market so that nobody gets, nobody pays, you don't pay offered side, you don't pay bid side, and by the way, Merrill Lynch made a commission on both sides of that transaction, so everybody is happy.
Liam, do you think, or Huey, do you think the value of information will come back into vogue, or must come back into vogue, or will the market forces drive it back into vogue?
I think that, I'd be very interested to hear you. I know your opinion. I'd be interested to hear you put words to it. But the way that I see it is, when the average hedge fund has fewer dollars in assets than the average Merrill Lynch financial advisor, right? They are trying to get the cheapest possible execution, right? When that herd gets thinned, as it inevitably will, people will understand the value of the information.
Right now, I liken it to lemurs. If you watch National Geographic, lemurs are on all over the place. And when that first one goes off the cliff, there are 50 more coming right behind them. Well, sometimes the buy side, they don't want to be the guys out there, stepping out there on their own. If they have a great idea, they may say, yeah, I have this great idea, but I'm only going to, like I said, I want to be a quarter of the volume. I don't want to be the only person who wants to be buying this thing, which it's kind of odd to me, because you would think it would be more of an alpha-driven decision that, I want to own ABC. I don't want anybody else to know that I'm buying it. You would think with the idea, I have a great idea. I'm going to execute on it, and then we'll see what happens. Instead, they want to just be 10% of the volume and want to see other people buying it along with them, which is kind of counterintuitive, but that's sometimes the mentality in regard to information is shared throughout the community, and sometimes people don't want to get burned along if they're wrong. That's the only thing I can surmise as far as being 10% of the volume. Granted, the original concept of not affecting the price of the stock as you're buying it or selling it is very important. They want to control how they are impacting the price of shares as they're buying it or selling it. Has gone way and has lost sight to. I just want to be following this thing along, because my target is to beat the S&P 500. this is speaking on mutual funds. Now, the hedge fund community originally, basically, they are an absolute return community, and those guys originally were like, we don't want anyone to know what we're doing. I want to buy as many shares of this as I can, as quietly as I can, and that's where I believe the value comes in, because if Liam has 1 million shares or something to go, how he treats, how delicate he is with that order, can immediately, their costs of trading and their benefits of trading, and how you handle the order definitely makes the decision.
Some very interesting stories that sort of leverage the human element. Steve Cohen at SAC uses a style that they refer to as information arbitrage, which I think is kind of a funny term, but they obviously trade with everybody, right? They're everybody's biggest account. And I'm not picking on SAC, but it's just a great company. They do a lot of business everywhere, and they're a great example of kind of the impact of flow and momentum. So they have relationships with everybody, and it's probably not entirely unheard of for them to tell their sales trader at firm XYZ, who they know has a big mouth, right? Oh yeah, I'm a buyer of this stock in size. And he then knows, the trader at SAC then knows that his sales trader with the big mouth is going to leverage that information. It's like, yeah, we got a large hedge fund buyer of this stock, and they know that everyone who he covers knows that he covers SAC, and so it becomes widely known that SAC is a buyer of this stock when in fact they're a seller. So the whole world's out there trying to get in front of SAC on this trade, and the SAC is selling the stock right into them.
You had a question back here. I'm sorry.
Well, can you kind of expand on it now? But like, think of Steve Cohen. What he's paying for in a lot of cases is really that network and that information than the market. But doesn't he have a certain level of pricing power too, as far as not necessarily the 1-2 cents trade? I'm just curious if we could talk a little bit more about that.
Well, also, I mean, where do you find people were willing to pay more? I used to run our ETF trading desk, and people were very happy to trade at never 6 cents a share, but 3 cents a share with us when my competitors were charging them 1 and 2 cents, because we would commit capital for them, right? They could call me and ask me for a price on 1 million shares of the Spider, and I would give them a price, and they knew that that was where they were executed when they got off the phone, whether or not that's where I was executed. And if I did better, I'd call them back and said, we did better, take this as a fill. So the commitment of capital is a very important part of it. But also, yeah, again, if you're trading 100 shares of GE, you should use a machine. It's a much lower cost alternative. Yeah. But if you're trading 1 million stocks of share, some 5-letter name that ends in a Y, you probably don't want to be using a machine for that.
Absolutely. And does anyone ever understand what committing capital means for trading purposes? Okay.
So I was going to say, elaborating on the skill it takes, the human element. What about trust? Because you've described trades where you executed on behalf of someone because of your knowledge of the book, but whatever you save that customer, you, like a better word, sort of got somebody else on the other side, right? You took advantage of that information. How do you, your customers know that you have multiple customers, and how do you manage that relationship?
I was fortunate and very happy that when I was on the floor of the New York Stock Exchange, I just received orders. I didn't know who the customer was. Now, it didn't take long for me to figure out when I screwed up and bought too many shares or affected the price, and they weren't happy with the execution, that not only the trader upstairs was calling down, but also the sales trader who covers a certain account. Then I was like, oh, this is those guys. So if I'm doing a good job, I'll never know who it is. In that world, I'm very much in a vacuum. Basically, I buy stock, I sell stock. That's what I do. The guys upstairs, that's where relationships are formed. And quite often, if one of the sales traders were to leave Merrill, it could significantly affect how much a certain buy-side customer was going to trade with Merrill, because if the traders on the buy side felt comfortable with that sales trader, they're going to stick with that guy. There are other times, though, where it's more about Merrill's ability, one being the ability to commit capital to a trade. Two, if we are the axe and it's something, I don't know if you guys are familiar with that term, but basically if you have both the buy side and sell side in a particular stock, and for whatever reason you are 90% of the volume in that stock, which generally never happens, usually more like 60 or 70 if the X, that right there can be a very powerful scenario for the sell side, and not that you leverage that, not that you leverage that to put the customer in a bad situation. What you do is you're able to provide a customer with a great service, and they know to come into you immediately, because all of a sudden, if Lehman Brothers is out there on the other side of a trade and they say, we're always buying from Merrill, the buy side customers say, I'm just going to go to Merrill and figure out what's going on, because then maybe I can get something executed and get 500,000 shares off immediately, as opposed to nickel and dime and going through this process.
And the other thing is, I mean, if 100,000 shares is going to get sold, well, let's say 1 million shares is going to get sold, to use Huey's example, and water finds its level and a stock finds the average execution. Right. What you're doing for your client is subtle but valuable insofar as you're allowing your client to be the buyer of the last 50. Right. When the average, maybe the average is going to be $100, right? You're allowing your client to be the buyer once it's well below 100. Right. But the market's still going to get the same average execution. And so when I talk about leveraging information, it is. I mean, there are specific rules against leveraging information against the client's best interest. It's generally for the mutual best interest of the client, as evidenced by when I use the Fidelity and American Funds example, where they basically are just, we act as the intermediary. And they're trying to do that with computers, but computers don't allow that because the Fidelity and the American Funds don't want to show their hand.
You have a question?
I'm interested in how accepted this practice of sharing of information, communication is between the buy and sell side. It kind of, in some ways, seems to me like a pre-devised manipulation of the market almost, because by selling so many stocks short, you're causing the price to go down, and you already know that someone else is going to be there to buy the shares that you're not going to buy back, and then the price goes back up, and you know well beforehand. Does that not make sense?
Are you?
What's going to happen, and it seems like
I have a far too expressive face.
on the market, and if you both had prior knowledge to that, how that is in violation of
Right. Yeah. The SEC. Well, they are a very successful and well received watchdog. I mean, if in the scenario we spoke about earlier, that to the point of there being abuse, I don't believe there's there's not widespread abuse in the marketplace. All in all, the capital markets work very efficiently. Now, are there at times some inefficiencies that may show up, and if those inefficiencies are there, was the intent, or was there an intent on someone's part? Possibly. I would say that probably happens 1 out of every 1,000 times. We're saying that back when they first put in the tick rule in regard to selling short and so on and so forth, there were some widespread abuses back in the 30s and 40s of the last century that they wanted to address. Well, they just recently got rid of the tick rule on the floor of the exchange, and the reason being because it really, the marketplace is so vast that there are always buyers and always sellers, and it's very difficult, one, to manipulate the market to your advantage, and two, it's very difficult to do it and do it such that you don't get caught. I think you're talking about the scenario he was speaking of before in regard to.
Yeah, I think the most important fact is the person who is trading customer business is not trading for the firm's account. The person who is trading for the customer may very well be risking the firm's capital, but in a very asymmetric way. Okay, let's say that you want to sell me, let's say that you're at a hedge fund and you are looking to reduce your equity exposure on an event basis, right? So you phone me up on the trading desk and you say, Spiders, how you making them? Which is code for, I want you to make me a two-way market. I want you to make it very tight. And if you make me a good enough market, I'm either going to hit your bid or lift your offer, right? If you're a really big hedge fund, I'm going to give you one price and you can either buy or sell there, i.e. I'm giving up any opportunity to make bid-ask spread, right? SPYs, how you making them? For you, 100 locked, right? Sold to you. Click. Okay? As the trader, I'm sitting there going, shit. I hang up the phone. I suddenly have to sell $100 million worth of S&P 500, right? It's either going to be 1 million spiders or $100 million worth of futures or $100 million worth of stocks, right? I just told my guy at hedge fund XYZ that he's done at 100, but what I meant was 100 or better. So in fact, there's an asymmetry to the client's benefit where if I actually end up getting executed at 100 spot 01 or 100 spot 10 or whatever, I go back and say, take a better fill, I got you done at 100 spot 10. And then that guy is never going to trade with another firm again. He's always going to come to my desk. And I'm always going to get his 3 or 6 or however many cents a share that he or she is paying. So it's not a question of, I know you've got 1 million shares of this to sell, so I'm going to go out and... What you described is called front running, and people go to jail for that. And they should.
Just to try and put it in a perspective, what's the average daily volume today in New York?
I'd say about 1.5 bill.
1.5 billion, maybe 2 billion. I'm only twice as old as these guys. And when I started, average daily volume was about 7 million shares.
You're only about 1.5 times as old as these guys.
So 7.5 million shares divided by the same number of stocks versus today 1.5 billion.
Yeah.
There weren't 50 stocks you could buy or sell more than 10,000 shares on either side when I started the business. Today, you made a 100 million locked market in SPYs. GE, last sale of the day, 41. If I went down there and said, I want a big by big GE quote, what would I hear back? Respectable. Would you make it 1 million shares on either side?
1 million shares is very easy to be done in GE, I would think. Very easy.
That's 12% of what I was looking at for daily volume. That's
Yeah.
just one stock.
That's what could be one trade.
One trade.
Yeah. He brings a very, very good point as far as the way volume has affected the efficiencies of the market. And also, we've gone from trading in teenies down to cents now. It's very difficult to really abuse a system where it's somewhat like a commodity. If I can go buy a pound of sugar for 21 cents, why would I not pay 21 cents for it? Why would I go across the street and pay 25 cents for it? The spreads are efficient in every regard, and the volumes have impacted how efficient the markets are. Which information are you talking about?
One you were talking before where he was really looking to buy the 1 million shares. He wants to buy it after everyone else has sold it, so he tells him he's going to buy, or he tells him he's going to sell, and then he really buys. It goes against what he tells, like the information he releases. Like, isn't that kind of a...
It's called spoofing the market.
Yeah, like is that legal too, or is that...
It's questionable, and that's why I said I'm not particularly picking on SAC, but it is interesting though. There's a lot of... one of the things that I was talking to Abe about was that there's a lot of psychology in finance. There's definitely a lot of psychology in economics. And sales is almost 100% psychology. And so you just know that the guy over at this shop has got a big mouth. And basically that's where it becomes a zero-sum game. It's either I'm going to be the victim or the beneficiary of this guy having a big mouth. Right? So I can leverage that because everybody knows he covers this firm, and if he says there's a large fund selling this, I'm going to be a buyer there, or I'm going to be a seller there. Ready for the math club meeting?
Yep.
Okay. All right. Just before we got in here, Abe said, "What's a structured product?" I said, "I have no idea. Hopefully, by the end of the presentation, I'll be able to tell you." Had you asked me when I left here in 1990, I say when I left, I actually did graduate. So when I graduated in 1990, if you'd said, "Oh, you're going to spend much of the next 17 years in derivatives," I would have said, "Okay, have you met me? Right? I'm the least quantitative person the world has ever known." Right? Turned out that I've been the victim of some very good fortune. Came here, had some great teachers here, went and worked for a bank, decided I didn't like credit very much. When it was in the investment management side, decided I liked that a lot. I decided I wanted to get my MBA and went to a pretty decent school with questionable admittance policies, as I said. Then I ended up working for a bank called First Chicago that no longer exists. And I went through their training program. And the training program was entirely interest rate driven. There was very little equity going on. And I wanted to be in fixed income because I thought it would be a good rigor for me to learn. And it was funny because had you said to me, in fact, I'd had a conversation with the lady who was running my training program, and it went something like this. I don't want to be in the training program anymore. I'm tired of being a trainee. Give me a phone, give me some clients, give me something to sell. Just don't put me in the derivatives group. Whatever you do, don't put me in the derivatives group. And I said something else. I said something very pejorative about the derivatives group. Literally 3 weeks later, they were laying off some of the 13 associates that they had hired in my class. And I got tapped on the shoulder by that very same woman. And I looked at her and I said, "You've got to be kidding me. Are you psychotic? I mean, is this like some sort of sociopathic thing? Why were you asking me what I wanted to do if you knew you were going to be shooting me 3 weeks later?" She goes, "No, you idiot. I'm not firing you. I've actually got good news for you." I said, "Yeah." She goes, "Come on off the floor." So I go off this trading floor that I'm working on. She says, "I've got good news for you. They want you in the derivatives group." Once again, I said, "Have they met me?" I mean, I said, she goes, "In London." Now, I didn't put up there that I have a minor in history. Right? I have a minor in history because I did an exchange program when I was here at Cambridge. And it was fantastic. And I'd always wanted to move to London, but I can promise you that I didn't join First Chicago because they were going to send me to London. I joined First Chicago because they were one of two firms that had offered me a job, and they were the one that still existed when I accepted. So, First Chicago. Thank you. I get over there. I'm basically somebody's flunky until he quits, and then all of a sudden I get his book. I finally get that phone and that something to sell. And I start to get really jazzed about interest rate derivatives, but even more so about equity derivatives because there's some creativity, there's a story, and I start creating financial products for these financial institutions. I used to cover what they call building societies. One very famous building society recently is Northern Rock. Okay? Building societies, generally they take in deposits, they lend out for mortgages. I covered a whole bunch of building societies in the UK and Ireland, leveraging my basic strength. Liam O'Neill. Irish financial institutions, Liam O'Neill, it seemed like a good idea. But I started pitching them structured products because that was the way to earn their bread and butter business, their interest rate swap business. And all of a sudden I realized I liked derivatives. It was like the book Green Eggs and Ham. I won't go into it, but I think you'll get the joke. It's like, I do like them. And so begins a career, right? Here it is. I'm 10 years at Merrill Lynch. I've been selling structured investments for every single day of those 10 years in one format or another. But structured investments have really come into vogue. And I think one of the worst things that can ever happen to you in your career is you can be on the cover of Business Week, you can be on the cover of Sports Illustrated, or Barron's can say you are the new hot thing. So it's been a good ride, but according to Barron's, we're in the mainstream now, so it's all over. But if you look at this is they talked about structured notes are here. And they're by no means new. Institutional investors have been using them for years. Nonetheless, the instruments are a clear sign that wealth managers and their clients are rethinking their attitude toward retirement. It's a process that's been going on throughout this decade. I've got news for you. I have covered private clients and I have covered institutions. We do a lot more interesting and a lot more value-added stuff for our private clients at Merrill than we do for institutions or institutions do for themselves. Institutions, largely by fear of the new and by decision-making by committee and by virtue of the fact that a fund manager is much more afraid of being fired than he is of having a bad idea, will very often avoid what is a very good idea, right? Because it's something different, right? People when it's somebody and it's their own money and you show them a proposition and you very clearly define what the risks are and what the benefits are, they can make that decision, right? And so that's why, actually, having run the institutional equity derivatives business on the marketing side for 3 years, I was given the opportunity to go back over to private client. Right now I work in a group that's a joint venture between the capital markets group, or the institutional side of the firm, and the private client side of the firm, which is exactly where I need to be to do my job. But quite frankly, I prefer the private client business because it's more interesting and there's more value add. So what are structured investments? Structured investments, generally speaking, are things that we create for clients based on a theme, an idea, or a need, right? Generally speaking, Structured investments are going to be either principal protected, they'll provide enhanced participation, they'll give you income, or they will just generally give you access to markets that you might not otherwise have gotten access to in an efficient format. So we've done a lot of equity-linked structured products at Merrill. We've done a lot of fixed income, a ton of commodities, and I think nowhere is it clearer than in commodities where structured investments can add value and can add efficiency. And we've done an awful lot of currency-linked offerings. Growing acceptance, as we talked about. The industry has grown explosively. In 2004, there was just shy of $10 billion issued in registered structured products. In 2007, and that number's looking light, it's estimated that there will be $25 billion in registered structured products issued. My firm has a 33% market share and has had approximately a 33% market share throughout that period. Right? It sort of goes between 25 and 33, which is a pretty good spot to be in. And Merrill continues to be the leader, both in terms of market share, but also, in my opinion, and because I run the business, I feel very strongly about this, in terms of business practices. Right? When you say derivatives, people still cringe and they get like a little freeze because of firms like Bankers Trust and things that happened to Procter & Gamble when you were all probably pre-high school. But when you talk about derivatives and you talk about structured products, by way of certain firms in the business that they do, they should have a bad name. Right? If you're selling something to a client and there's not any reasonable chance that they might understand what you're talking about, you're probably doing a bad thing. Right? Question.
We spoke about some of the new products earlier. I was just going to ask how you plan to maintain that market share or increase it.
Bigger, better, faster. Honestly, it's a question of our business. We haven't done anything to fuel the growth. We've done things to fuel. We've done things, shall we say, everything in a structured product itself is only interesting to the structurer and the structured product salesperson. To everybody else, it should be considered a vehicle, right? It should be considered an envelope or an alternative. I had an argument. Well, this will resonate with everybody in the room. I was watching a basketball game after I had done a presentation. I was watching a basketball game. It was a University of Florida, Ohio State basketball game, right? And I was watching it with a senior manager who was an Ohio State grad, and I was taunting her. And this person came up to me and wanted to have a very spirited debate about whether or not structured investments were an asset class. And for the record, I get paid to sell structured investments. I definitely don't think they're an asset class. First of all, it would be self-serving for me to say they are, but they aren't. Asset classes are those other things I talked about: equities, debt, fixed income, currencies, commodities, all that stuff. And the guy was like, no, they are an asset class. And I was like, no, they're not. And finally I looked at him, I said, is a mutual fund an asset class? He goes, no. I said, there you go. He still didn't get it. And literally it was like, I'm like, do you know there's a basketball game on? I'm like, do you know there's 5? I said, if I tell you that I do think they're an asset class, will you go away? And he did, so I did. But at the end of the day, what we do is we don't start with company A needs to raise money, right, either in the form of equity or company A needs to borrow money. And how little do we have to pay you to get you to give that money to the client who needs to raise it? Instead, we start with, well, we've got a really good chief investment strategist, and he thinks this. And we've got some really good structurers, and we can actually take this idea, figure out a client need, take this idea, this structure, and put them together so as to make it more than just, well, we think high-quality stocks are a good idea right now. Okay, that's great. What's a high-quality stock? Right? We'll give people a way of buying those high-quality stocks in a very tax-efficient way, or we'll create an index, or we'll give them a way to buy it so that they don't have the downside risk, or we'll give them a way to play it where there's leverage, but it's only leveraged to the upside as opposed to the downside. And I've got some decent examples of that as we move along. So what we've done, the one thing I learned, a rookie manager mistake is to look at the numbers and just stress over them and hope that they grow. There's a lot of levers in between getting real growth and setting out to get the real growth that you have to pay a lot of attention to. But just stressing over the numbers or planning for growth's sake is a sucker's bet. Right? You've got to be doing the right thing every day in order for that growth to come. And what we've done, quite frankly, is just aligned ourselves with smart people who've got good research ideas. We've aligned ourselves with good portfolio theory. And we've aligned ourselves with understanding that it's really hard for an individual investor to own commodities. right? Jim Rogers knows an awful lot about commodities. He's rich beyond description as a result of his partnership with George Soros in the early days. This is the guy who's always on CNBC with the bow tie. He's about this tall. I know this because I went all over the United States with him, walking around. Everyone thought I was his Secret Service agent. But when he stood on his wallet, he was like this tall. But you know, he has written several books, one of which is called Hot Commodities. Kind of an offensive title. But this guy created a commodities index. And he created it because he was going to drive a car around the world. And he wanted to buy some commodities, and he wanted to have an index that was rules-based. And I'm a big, quantitative guy now, in spite of my history. I'm big into quantitative investing and being rules-based because I think the hot hand only lasts so long. I mean, Bill Miller. How does Bill Miller at Legg Mason beat the S&P 500 15 out of 16 years? I don't know. The difference between alpha and beta, right? If you can write it down on paper, it's beta, right? Alpha is an ephemeral concept unless it's something called structural alpha, and I'll talk about that in a little bit. But and you all know this because you had to take the class on alpha and beta, but just so I'm sure I know it. Alpha is if the market's up 15, you take exactly the same risk and you deliver an 18% return, congratulations. You've just delivered 3 points of alpha. Well, I can show with structures a way to take less risk or the same risk and get 3 times the performance within certain parameters, where your worst case scenario is you've got 1 times beta to the downside, or you're going to leave a little bit of money on the table if the market rips to the upside. But by the way, this probably isn't going to be your only exposure to the market, and nobody's ever complained when one of our offerings that gets capped gets capped. So I think that was an extraordinarily long answer to a simple question, but I'll soldier on. So I talked about why use structured investments. They're investor-oriented. They start first and foremost with an investment idea or a theme, right? They don't start with, I need to raise money for this company, right? And so when you want to talk about emerging markets, look good. Well, emerging markets are generally scary to an individual investor. You've got ETFs. Those are investor-oriented, right? It's like here's an index based on the emerging market, MSCI Emerging Market Index. It's a good sort of a proxy. But that's what I refer to somewhat disrespectfully as dumb beta, right? It's just own the market up, own the market down. There are different ways to own it where you can actually change the shape of the payoff, and I'll show you graphically what that means in a minute. But I refer to that as structural alpha. Ease and efficiency of implementation is another way. I mean, there's lots of things that you can do. How many people in this room know what the CBOE BXM index is? The S&P 500, the BXM index? Anyone? Bueller? Very simple index. You buy the S&P 500. Every month you write an at-the-money S&P 500 call. Every month it expires. Every month you write a new S&P 500 call. You own the underlying stocks, right? So if the stocks go up, you've sold away the upside. If the stocks go down, you've got downside risk, but there's a cushion there because you're taking in all this option premium. Well, history shows us that over time, that is a superior strategy than just owning the S&P 500 outright. Because the volatilities in options, particularly S&P options, tend to trade rich, right? So by going in and monetizing your potential upside every single month, you are likely to get equity-like returns with about 2/3 the risk. So in fact, one could argue that you could then lever up so that you could have the same level of risk and have about 1.5 times the return, right? Great strategy, unless you happen to pay income taxes, right? If you're an individual taxable investor, you're screwed if you try to do this strategy because every time you write a call option, that's ordinary income. You're going to pay most of your gain away, right? So we created a note where effectively all we're doing every month, we're writing an at-the-money call every month it expires, right? You're long the S&P 500 on the underlying, but because we've built it into a note and we put it into your portfolio, what effectively you really end up with is a note that's linked to this index, but nothing that goes on at the index level causes you to have any sort of tax inconvenience, right? Inconvenience is a euphemism. Tax impact. You're getting all of the kind of NAV accretion, but you're not getting any of the really messy part, right? So it's a total return note that provides you with the return of the strategy without having to pay away all the gain. So ease and efficiency of implementation. Expanded access. Question?
You talked about it a little. What percentage of the products that you structure would you say you're doing because of taxation purposes?
Less than 10.
Less than 10.
Yeah.
What would you say is the main reason you're making a lot of these products for investors?
the fact that they're investor-oriented, they offer ease and efficiency of implementation, and expanded access.
I mean, like why do investors come to you and say, I need this product because?
I'll show you. I've got some very concrete examples. The people who come up with transactions for tax reasons have very lucrative but short careers, right? Because they end up bending laws and having very, very aggressive interpretations. And remember Icarus? You go down in flames, right? You guys don't even know mythology in here? What are they teaching you? The real point of this is expanded access, right? As well, where commodities are hard for an individual investor to own. Let's give you access to commodities in something that looks like a stock, right? Let's give you access to a hedge fund that's closed. Let's give you access to a hedge fund that you wouldn't be able to buy unless you had $10 million to put in it, but I can make it available to you in $1 million slots because we're going to make this a much bigger transaction and we're going to provide you with better liquidity terms. I mean, there's all sorts of things that you can do in terms of aggregation and the structuring that make it a better investment for an individual, and that's what structured investments are about when done right. When you talk about why using structured investments in your asset allocation, I would argue that for both your equity and your fixed income and your AI, I haven't really figured out how to be core and tactical in cash, but I don't know how to get that part of the slide out. But that says AI up there. You know, there's really a core and a tactical element to your entire asset allocation, and we've got products that fit in both of them. The Mariner 50-50 warrant. 50-50 does not refer to the chances of winning. 50-50 means 50% of it is in a fund of funds that is administered by Mariner, which is a very successful fund of funds manager, but the other 50% is in the Mariner Partners Fund. Generally speaking, the only way that you were able to get into the Mariner Partners Fund prior to this was you had to be a Mariner partner, meaning you had to be one of the founders of Mariner, which means you are so vastly wealthy that you can go to any other hedge fund you want and put in a big slice there too. This is a warrant that provides unbelievable tax efficiency, right, and very low-cost leverage. So for somebody who wants to get their asset allocation more exposed to AI without that tax mess and all that's associated with K1s and you know, sort of uncertain mark-to-markets and things like that, the warrant's a great way to put less money on the table and use the benefit of leverage on the upside. Currency notes are another core in my opinion. We've got a commodity index, and these are real-life products that I've got on here. In fact, this is the same presentation that I would use at the Punta Gorda office if I were there. We did a note for clients who thought crude oil was far too high. Unfortunately, we did it a year ago, right? So the people who bought it got clobbered, but we built it in such a way that the most they could lose was 10%. They got 3 times participation in the depreciation of oil, and if oil was anywhere below 64, they were going to make like a 30% return. Unfortunately, oil is significantly above 64, and so they've lost their 10%. If you define somebody's downside, you make it a lot easier for them to make an investment decision. This year, when this came due and it was about to mature, people were like, yeah, we're going to want to roll into a new one. And I said, well, I'm not going to be able to protect your downside at 10% anymore. Are you still there? Right? I mean, with oil as high as it is, I'd love to be short oil. But the problem is our research strategist said, I think the risk-reward of your trade sucks. Well, he knows a heck of a lot more about oil than I do. All I know about is structures, and the last thing I do is structure for structuring's sake, because then it stops being an investment and starts being a fad. On the equity side, I'm going to talk to you about a bunch of different things, but the accelerated return note is our simplest product and not coincidentally our most successful product, both in terms of its performance and the adoption rate within Merrill Lynch. I mean, 56% of the firm's financial advisors have sold a structured investment to their clients in the last 12 months. I mean, that's 10,000 people. That's 10,000 financial advisors. When I started back in the group 3 years ago, I can't remember if it was 34 or 43. At bonus time, I tell them it was 34. But 34% to 56% means we're doing something right. And the thing that we're doing that's right is we're giving them a lot of reasons to believe in the product. And I'll talk about what we do a little differently as we move along. And I'm tired of this slide, so I'm going to get rid of it. Actually, no, I will talk about one fixed income idea in deference to the fixed income bias of my host. A tactical transaction. Hey, I got a view that 10-year rates are going down, right? I have a view that 10-year rates are going down. And as a result, here's a 2-year note that pays a 9.25% coupon upon redemption Okay, so but it's an annualized coupon. So effectively, there's 2-year note. Semi-annually, they will look at the rate of the 10-year CMT, which is the constant maturity treasury. Do you all know what that means? Just consider it the on-the-run treasury. The 10-year CMT. If the 10-year rate is lower than the spot level on the day that we price the note, this thing will get called away from you at a 9.25% coupon. So in the first, you'll get 4 and whatever, 9.25 divided by 2 is 4 1/8. Sorry, 4, a little more than that. You'll get 9.25 if called in the second observation. You'll get basically, you see where I'm going with this, but it's a great tactical way to play rates, and all you have to do is be right directionally. Right? That's a tactical transaction. We also do lots of other things to give people who are afraid of fixed income right now because they think it's rich, ways to generate income without having bond exposure. Question?
Yeah, you can answer this as you go if you like, but all those products you have, some of them it sounds like came from your research on the inside, and also some of it came from what somebody might call reverse inquiry or clients, financial advisors, people out there touching the customers are saying they would like this product. Percentage-wise, would you guess?
I wish it were closer to 50-50 because it would make my month less stressful when trying to come up with the October calendar. It's probably more, at this point, 60-40 to 70-30, where the ideas are we're looking over the research, we're talking to the research analysts, but some of our most successful ideas have come in from RFAs because RFAs know their clients and know what they're looking for. But we are sort of committed at this point. We bring about 12 products a month. It's hard to come up with 12 products a month, Bruce.
Liam, how many idea geeks do you have working with you?
There's nobody who's a designated idea geek. I mean, I've got 11 salespeople, and I've got 7 people that work on a desk in New York, and then there's a whole bunch of people in origination. But generally, it's become a very sales-driven organization because we don't want structures for structure's sake, and we don't want ideas because there's a lot of tendency among.
Too cute?
Yeah, too cute is exactly the phrase we use sometimes, where it's like, well, what exactly is the economic rationale behind this transaction? Well, the numbers work. Okay, so let me get this straight. You want me to go massively long the Venezuelan bolivar, if it's still called that, right? Because this bond happens to coincide nicely with this call. Well, yeah. Like, yeah, our currency analyst thinks the Venezuelan bolivar isn't worth anything, but you want me to buy it. Yeah, he doesn't know what he's talking about. I'm like, no, you, sir, don't know what you're talking about. Let's be clear. Just to talk about alpha, I talked about manager alpha and I talked about structural alpha. If you look, it is staggering to me, if you look at large cap, it is staggering to me that in a market that is said to have a tremendous amount of breadth, and it is allegedly easier for a manager to outperform their benchmark or their broad index, it's staggering to me that in that same period, 3 out of 4 large cap managers have underperformed their S&P 500 annually over the last 5 years. The analogy I used earlier today was, okay, if you see me and I'm standing under the basket, and I've got my hands out, I've never made a basket, right? Don't throw me the ball, right? I'm good at like elbowing people and getting them out. This notion that, no, we'll just keep buying managed product because these managers will get it right eventually. That's hopeful, but hope is not a sustainable strategy, right? It speaks directly to why there's currently $5 billion in large cap ETFs held at Merrill Lynch, and more importantly, why, just when we talk about passive investing, why people are voting with their feet, right? It's envisioned that right now there's about $500 billion in passive investments just in the form of ETFs. I'm not talking about what's at Vanguard or what's at Barclays in index funds. This is just ETFs. Right? It's envisioned that the ETF market goes to $1.4 trillion by 2011. Why? Because 3 out of 4 fund managers that are charging you 150 basis points a year for the pleasure of not beating their benchmark, they're not punching their weight, right? So these managers are driving money into these ETFs. So that's when I like to talk about the practical application of structural alpha. Okay? If you own an ETF, you own pure beta. And what that translates to is the market goes up 20, you go up 20. In fact, you go up 19.91% because the spider has a 9 basis point fee, right? And we'll assume you didn't pay any commissions, right? Market's up 20, you go up 20. Market's down 20, you're down 20. Dumb beta, right? Structural alpha is in every one of those scenarios, and these are all things that we sell on a very regular basis. Dark blue line is your payoff profile. Light blue line remains the index, right? Here's something called a 5150 note, where you've got 150% participation in the upside of the index versus 50% participation in the downside of the index. It's just a combination of options. It's really cool. Unfortunately, you can't do it with every index. But if you do this on the Nikkei, you suddenly have 150% participation to the upside and only 50% of the downside risk without limitation. On the upside, that is. You clearly can only lose 50% on the downside. Down here, this is a MITS. This is a principal protected note. It's the simplest structured note structure that exists. It's a bond plus a call. But if the market's up 50 and you have 105% participation, market's up 50, you're up 52.5. Market's down 25, well, that's a lot of alpha, right? You're not down at all. This is something called a leverage index return note, where you've got 110% participation to the upside, a 10% cushion against downside, and then 1-to-1 downside thereafter. Let me point out, the definition of alpha is outperforming the index, taking the same risk. I would argue here is the clearest definition of alpha. I have the same upside, greater upside to the upside, and no downside risk. Here, I have a superior return, right? Here, I have a superior return at every point on the index.
And who's the issuer of the note, Merrill?
Merrill Lynch. So, in fact, what's the risk?
What about my Merrill risk?
Right. I was going to say, it's not without risk because you're buying a Merrill Lynch debt security. And if Merrill Lynch has a $4 billion write-down in credit default, the CDO market, you have Merrill credit risk, which is why we bring in issuers like AIG and Toyota Motor Credit. There's always a risk in an investment. You just have to be able to quantify it. So when people buy a lot of these, they take Merrill credit risk. This is the accelerated return note, and I'm going to talk more about this as we move along. In fact, I'll just go to that slide. So again, we know that ETFs, pure beta, market up 5, you're up 5. An accelerated return note. If the market is up 5%, you're up 15%. Okay, this is a note that gives you 3 times participation to the upside with only 1 times participation in the downside risk. So in terms of risk, you have the same risk as owning an index fund. Sorry, it's lasering you. To the upside, index is up 1, you're up 3. Index is up 3, you're up 9. Index is up 5, you're up 15. Okay? Index is up 10, you're up 15. Index is up 20, you're up 15. You're going to leave 5% on the table. Right? So you've got 2 risks here. One is that the market goes down, and the other is the market rips to the upside and you left some money on the table.
As far as buying these products and thinking about where the market goes, do the FAs make that choice or do the clients?
How do you mean?
As far as, does the FA or the client think that the market's not going to go higher than, because you're capped at 15% there?
It has less to do with where you think the market's going and more to do, and this is one of the reasons that I think we've had as much growth as we've had, is the fact that we don't want people implementing, we don't want people making separate and distinct decisions on one-off bases and then calling it a portfolio because there's a bunch of them, right? It's better to think of it in terms of, okay, I have a long equity portfolio that will grow without limitation to the upside and has full downside risk. How does this coincide with that? And as I soldier on in this presentation, you'll see that it has a really interesting effect because basically everybody that I care to listen to right now talks about single-digit equity returns, right? Bob Dahl, who's the chief investment officer for BlackRock, formerly known as MLIM, Merrill Lynch Investment Managers. Rich Bernstein, who's our strategist. If I listen to probably my favorite, Jeremy Grantham, it's single-digit returns, but they're going to be negative forever, right? And he's an asset allocator, and God love him, he's never lost money. And he averages 10% a year with very little risk. That's what diversification's about, and that's what sort of being smart in a portfolio context is about. This note in and of itself is cool, right? This note in a portfolio, I'll show you in a minute, makes it a better portfolio. Just to give you an idea, is there another question?
Are these structures kind of simple, not simple, but easily replicated by your competitors?
Yeah, I'm actually about to show you how to build one yourself on the very next slide.
How do you maintain that market share when your competitors just come out and lowball?
They're not. No, the cool thing about what we do is I work in a joint venture between private client and the institutional side of the firm. Everybody else who has my job on Wall Street works for the institutional side of the firm and is beholden to a trading book, a single trading book. I work for basically, I want to temper what I'm about to say. I work for a firm that places a much higher value on its private client business than any other firm on Wall Street, which, by the way, is tempered down from what I was originally going to say. I work for the only firm on Wall Street that gives a shit about its private client franchise. I'm serious. It seems like UBS and Morgan Stanley and Wachovia, they can't figure out if they're in it or out of it. My firm, 40 or 50% of the revenues on an annual basis come from private client, and it started as a private client firm, and our name is on every corner, right? When they go after brokerage firms, we're always the first one they come after, because we're the only ones that everyone knows. But what we do, the way that we do our business, when I show you this note, this Russell 1000, let me show you, here's a perfect example. S&P 500. Last month, the month of August, we were offering an S&P 500 accelerated return note, which is this thing, right? 3-to-1 upside. We actually showed a range of 12 to 16% because at the day we priced it, the day we printed the prospectus, the fair value was at approximately 14. So we show a range of 12 to 16. Gives us a little bit of flexibility for market movements along the way. Obviously the market volatility spiked significantly. That's a good thing when you're doing a combination option strategy. So what we did, a few days left in the market, as we do with every one of our transactions, we went out and we called Barclays, Deutsche Bank, Goldman Sachs, and a number of other derivative trading shops and said, we have about a $500 million transaction we'd like you to price. And it has, as you'll see in a minute, a lot of options in it. There's 5 options in it, so it's about 3 times levered. You end up with, we've got $1.5 billion options trade. Would you be interested in that? Eyes get big. We become one of the most important trading counterparties on the street. And we're not beholden. Of course, Merrill Lynch gets a bid. But 4 other firms get a bid. So we are the only firm on Wall Street that goes through what we call a commercially reasonable pricing exercise. And we will absolutely trade away from our own firm if somebody else has a better bid or is a greater fool. Okay? In the case of the S&P 500 trade, we came out with a 14 to 18%. Sorry, this is a different term because this is for the September offering, but in the August offering it was 12 to 16%. We executed that transaction with a cap of 18.87%. Okay, so you, Dominic, showed it to your client and said, you know what, I think this is a good idea. The range is 12 to 16. They'll probably come in at 14, but you know what? The market need only go up a third of that for you to get a 14% return. By the way, the historical return of equities is lower than 14%. Looks like a pretty good risk return. We could have come back to you and said, Dominic, this is the best. We executed at 16. Isn't that great? Your cap is 16%. Okay? Had we done that on the single largest equity-linked note ever done on Wall Street, pardon me, for individual investors, we did a $516 million offering. And quite frankly, the reason it was so big is because Merrill Lynch advisors trust the pricing they get. And the reason they trust the pricing is we came back and gave them an execution of 18.87%. Had we just executed at 16%, okay, that would have been a windfall to the trading book of about $8 million. And I'm not exaggerating. Okay, $8 million. If I were beholden to that trading book, you can be damn sure I would have executed you at 16%, and that trading book would have made $8 million. Because I'm employed by a firm that wants to make sure that the pricing that the clients are getting is fair, that $8 million, it is a zero-sum game. Had to go somewhere. It went to everybody who bought the note. They got a better product. So that's one of the things we do differently, and that's what I was talking about when I said business practices. This isn't Pollyanna stuff. I can point to real live numbers. It's not like we have a higher code of ethics. We do, right? But this year we've put $21 million back into the pockets of our clients, right? But you know what? The only reason we're able to do that is because we do such large offerings, and the only reason we do such large offerings is because we do that, right? There's a lot of other firms out there that are pricing $10 million every month. Whoopee, right? And they're really taking a slice out of the client. That's just bad business. So accelerated return note, you asked, could this be replicated? Yes, it could. In fact, I'll show you how. On the S&P, you could go out, and this can be $10, this can be $10 million, it can be $10,000, right? Go out and buy the Spider, our friend the Spider, and then go buy 2 at-the-money call options, right? Those will cost you something. Let's say they cost you $6 each. You've got a $12 option premium bill. You could either pay that out of your pocket and then hope that the S&P goes up. And in this case, let's say you did $100 worth of it, right? You want the S&P to go up more than 12%. Well, actually, because you've got Now, 3 times upside, you want the S&P to go up more than 4% because that's your break even. But instead of having a break even, having that $12 bill you have to cover, you can instead sell 3 out of the money calls. Where are they going to be struck? They're going to be struck wherever they have to be struck to generate $4 in option premium per contract. Right? It's that simple. I'm living proof that anybody can understand this. Right? $12 in option cost, $12 in option premium intake. You've offset the transaction. It's self-financing, and you've got 3 times upside up to a cap of, in this case, 18.87%. Right? So that's what it's made of. And we use this slide a lot when talking to financial advisors because we don't want people to walk away thinking sounds too good to be true. We also want people to know that there's a long equity exposure, there's 2 at-the-money calls, and there's 3 short calls because that's what it's going to be the day that we price it. That's what it's going to be every day of its life until it matures. And then on maturity, it's going to pay you 3 times the upside subject to a cap. But during its lifetime, it's going to price like this. And options have deltas, and the higher the index goes, the more in the money the option will be, and so the higher the delta it will be. But it's not going to value like an ETF on a day-by-day basis. So that's why I say to people the best way to own these is to own them through maturity and then roll them. Right? A lot of folks are using this as a complement to their long equity exposure. But let's talk about the core.
Is this a better product in or outside of a tax-protected account?
This would be, by virtue of the fact that every time one of these matures there's a tax impact, it would be a better strategy inside of a non-taxable account, an IRA.
401k, an IRA, someplace like that.
Yes, because that would be the one limitation of the strategy, right? Because you do have that tax bill to pay. But let's just take a quick look. I mean, we had 38 of these things mature in the last sort of 2.5 years, I guess. 38 of them matured. 29 of them really represented core portfolio holdings, whether they were the S&P 500, the mid-cap index, the Russell 2, the NDX, the Dow Jones Industrial Average. I threw commodities in there. That was an editorial comment. Editorial comment meaning that commodities are a core holding. 17 of the 29, and by the way, I don't know how that impacted the statistics, so I'm not lying with the statistics using the commodity note. 17 out of 29 outperformed their underlying index. Right? So 17 out of 29, and on average, the ones that outperformed by 8%. That's a lot of alpha. But forget about that for a second. And just for indication purposes, I'll show you that 27 of them actually delivered you positive return. So what we can say then is 10 of them underperformed, right? Because 17 outperformed, 27 gave you positive performance, and then that means 2 of them went down with their underlying indexes. What's more important to me and what's more illustrative to me is that the average performance of all 29 notes was about 17%, while the average performance of the underlying indexes from the same point to point as the notes was only 15.2%. So we're generating about 170 basis points of alpha from just systematically using the program. Wash, rinse, repeat. Right? Use it as a core holding. So let's quickly recap how these work. In a moderate return environment, assume you have a manager that can deliver the benchmark, right? Generously speaking. The manager delivers the benchmark return. The ARN delivers 3 times the benchmark in a limited return, in a moderate return environment. In an aggressive return environment, say up 20, yeah, you'll leave some upside on the table. In a down market, you'll have exactly the same downside risk. So your 3 scenarios are, wow, really glad I have this in my portfolio. If you look at it in isolation, wow, this is better than managed money. Wow, this is worse than managed money. Wow, this is the same as managed money, right? That's not the way to look at it. The way to look at it instead is how does it work in the portfolio context? If you're 100% managed versus 80% managed and 20% in the structural alpha alternative, and this is using just a 15% cap. In a moderate return environment, 5%, by being 100% managed, you're going to get 5%. And by the way, that's before fees. By using 80% managed and 20% in structural alpha, you make 5% on 80% of your portfolio, which is 4. And you make 15% on 20% of your portfolio, which is 3, hence 7%. You've outperformed by 2% in a very moderate environment. We have FAs who are aiming to go slightly more aggressive in that direction. They are 50% long and 50% structural alpha. So in that very same environment, their clients, by taking no additional downside risk, will get double the performance of the market. Right? Same thing. You got 5% on 50% of your portfolio, and you got 15% on 50% of your portfolio, added up, that's 10 in a 5% environment. The beauty of it is, in the strategy, when you're 80-20 or even 50-50, you're leaving a lot less on the table because your long portfolio grows without limitation. So it's not so much about calling the market when you buy the products. It's more about, in this environment, your portfolio benefits dramatically by having it in the portfolio. In this environment, it doesn't suffer much by having it in the portfolio, notwithstanding the fact that there's a cap. And here, you're indifferent. Right? If you want to talk about not suffering from downside, we'll show you some principal protected options. But really, I think one of the things that really clicked for financial advisors at Merrill is that A, we were working for them. We only served them as a franchise. And B, we were trying to show them how to use these things in a portfolio context, not as the hot dot. We've shown them some other tactical ideas. We did a really interesting transaction on the PhilX Housing Index, a bear note. Basically, this is just like the ARN, but it's to the short side. Right? So basically, we gave people an opportunity to capitalize on the downside. Again, blue line is the index. Dark blue line is the payoff profile. We gave people a way in a short-dated note, say 12 months, to capitalize on a downward movement in an index of companies that predominantly are in the home building and housing sector. Right? Goes down 6%, you make 18 to the upside. We have made a significant amount of money for clients on this. But we also put them in a scenario where people are scared of shorting stocks, and they do have short exposure here. Right? So instead, we actually put in a buffer. They had a 10% buffer so that if these housing stocks were to appreciate, they were cushioned on the first 10%. Right? If they appreciate by 12%, you start to lose after 10. So if the stocks are up 12, you're down 2. Right? So there is risk. But this is a much more sort of, okay, let's figure out who our client is and what the profile of the risk profile of the client is. Give them an opportunity to hedge something that approximates housing. And it's not a perfect proxy. There is no perfect proxy. Not even the Case-Shiller indexes are the perfect proxy. They've got derivatives that trade on the Case-Shiller indexes, but they're illiquid as hell, and they're a national index. And if you live in New York, you've got a very different basis than you do if you live in Newport Beach.
That's where I was going. I was kind of interested. So the earlier ones were easy to understand exactly mechanically how that works.
Mm-hmm.
But this one there's some number of names in the PhilX Housing Index.
Mm-hmm.
And there are traded options
Mm-hmm.
in all those, and so that's where you bid it out.
Yep.
And if there were liquid options in the Case-Shiller Index, you might do that.
Absolutely. Here, this is the absolute inverse of that other thing, right? Where instead of buying the stock and buying 2 at the monies and selling 3 out of the monies, what you're doing is you're shorting the stock, buying 2 puts and selling 3 out of the money puts, I hope.
Now, would any shop, if you bid it out, maybe hypothetically, suppose you want to do something where there is no traded option, so you bid it out and they might delta hedge it or do it if it was.
Yeah, I mean, we're dealing with shops just like ourselves, and we do an awful lot of over-the-counter where you're going to get the most liquidity in an index, but we bid out we just did an exotic, we just did a transaction based on Apple that was effectively a buy right. Everybody in the room knows how to do a buy right, particularly if you heard what I just said, buy right, right? You buy the stock and you write a call option. 3% of the firm's clients are options approved, right? So if we want to show them an enhanced yield opportunity, we can show it to them in a note. And the only difference between our offering and just a straight-up buy right is this one was a 2-year with a no-call period for a year, and then it's callable every day thereafter, and the price at which it is callable amortizes upward, so as to give them a yield to call of 20.01%, which includes a coupon of 10%. Right? We priced that away, and in fact, somewhat embarrassingly, one of our competitors provided a very, very aggressive price, and we said, and you have to do this because one day it's going to be you. You have to do this. We say, are you sure? Yes. Are you really sure? Yes. You sort of go away. Okay. Would you reprice? Yeah, that's our price. Sold to you. The next day. That trade we did? It cost them $3 million because they wanted to do the business with us. And they bid too aggressively. They were off on their model. And we did a $100 million transaction. And it's real easy to lose money there. And generally speaking, in that scenario, you let the other person off the hook, unless, of course, you're an intermediary that's serving a financial advisory community, that's serving a whole bunch of individual investors who just found out that they got priced at X and have a yield to call of 20.01, you can't go back and, you're effectively, you're short economically to them at that point. And so that competitor firm had to honor its side of the trade, albeit not the most economically beneficial side for them. So tactical trades can happen. This is that 5150 that I showed you. This is a long short note. It's interesting. There's a real phenomenon among the long-only community where they want to be more like hedge funds. What they really want to be is compensated more like hedge funds, right? 2 and 20 is much more attractive than 1 and a quarter, right? 2 and 20% of the performance, particularly if you're making a lot of money. And so they want to have more alternative investment style. And so they do things like it depends on with whom you speak. Some people call it 30-130 investing. Some people call it 130-30, where effectively a long-only manager is instead of being just long 100%, they'll be long 130% and short 30%. So in other words, they'll be short, and through the shorting, they'll actually get the leverage have the leverage to the long side. All right. So effectively, they are still long 100%, but they're also having the portfolio dampened in terms of its volatility, but they can make money if it goes down, things like that. And this has been a big academic study, and people are really getting into this. We've been doing these, and they're very cleverly named, long short notes for about 5 years. And effectively what it is you're 150% long the underlying economic exposure, and you're 50% short a different economic exposure. So not to be confused with this, where you're 150% long the upside and only 50% exposed to the downside. This is a totally different proposition, because here you are, in the case of the very first example, you are long utilities and healthcare, and you are short the housing index. This was a long short note. This was an implementation of our research call, the sectors we love versus sectors we hate. You effectively had $150. Basically, Dr. Brown gives me $100. I buy $150 worth of those two sectors, and the way that I was able to finance that extra $50 is I'm $50 short the housing sector. It matured in January of 2007. By way of comparison, we used the S&P. The index had been up 20% over the same period. The note delivered a 26% return. The beauty of these is you can actually make money in a down market. You can make money on your shorts. You can make money on your longs. You will have less volatility. But the beauty of these is also long-short investing is traditionally the province of hedge funds. And hedge funds are also something that fits into the category of often mistaken for an asset class. There's lots of strategies that are employed within hedge funds that are part of an asset class that falls under the category of AI. But hedge funds are simply an envelope or a vehicle through which these strategies are implemented. And they're not really the most investor-friendly envelope, right? There's a tremendous lack of transparency. There's tax inefficiency. There's a lot of things that make them ugly. And oh, by the way, for the most part, the only way you can get into one is if you happen to have at least $5 million in investable assets. And for most, if you want to go direct to them, you got to give them $10 million and promise that you won't ask for it back for at least a year. I mean, good luck.
This is very interesting stuff, because I think a lot of people that are think about their portfolios and watch the market, you might have a thesis like this, right?
Mm-hmm.
Apart from how it performs, it's just that I think Asia's going to outperform the U.S. I buy this, right?
Yep. In fact, we've done the MLCPR index. MLCPR, Rich Bernstein, who's our chief investment strategist, is always a huge proponent of buying quality stocks. And in a low-quality rally, he gets his head handed to him. But you know what? He sticks to what he knows. And in this case, he was saying buy the most beleaguered stock or the most beleaguered sectors of the prior year. Here, you're long telecom, you're long media, you're long pharma versus short consumer discretionary and short materials. This, it says matures because I haven't run the numbers recently, but its index was up 9%. The note made 30. Right? We did one that was long the Asia Select 50. Oh, that's this one. Long the Asia Select 50, which were the 50 highest quality names in Asia ex-Japan, and short the NASDAQ 100. So you're buying Asian high quality and you're shorting low quality U.S.
So elegantly simple.
It's so simple because what you have is a note, right? The note is the envelope here instead of a C37 hedge fund.
I mean, the short sale it tempers the text, but it gives you the leverage, the proceeds, lever, it's really...
The leverage is built in. You've got you've got long-term capital gains on the net effect. You've got complete and total transparency, and you've got daily liquidity. And that's, literally anybody who has an account, this is not an advertisement, but anybody who has an account at Merrill can buy one of these things.
And with these indexes, you're picking you got a little bit of the dogs of the Dow thrown in as well.
Mm-hmm.
You buy, out of favor,
Mm-hmm.
in favor.
Question.
What's the typical minimum investment on these? If you're starting to buy?
This one, $1,000. It's a $10 security, 100 share minimum. Honestly, we don't believe that good investment strategy should only be available to people with $5 million or more. It's the broadest demographic of Merrill Lynch's client base does not have $5 million in investable assets, right? The broadest demographic of the investing public does not have more than $5 million. And we don't think that you have to give, I would rather have the transparency. Now, that said, and I said this at lunch, there are certain managers, if I could get access to them, I would take whatever conditions they said. 10-year lockup? Sure. Okay. I won't ask for it back for 10 years because these guys have either, like Paul Tudor Jones, has never lost money. Steve Cohen, his worst year ever after fees was like 30%. If you think about hedge fund managers, they generally charge like a 2% flat fee and then 10% of the performance. Steve Cohen doesn't charge a flat fee at all. He just charges 50% of the performance. This guy delivered 30 after fees. However long you want to lock me up, Mr. Cohen, I'm there. Right? But hedge funds also tend to throw off a lot of short-term capital gains because they trade a lot. That can make for a tax inefficient return. Mind you, it's never a bad thing to be paying the taxes because it means you're making money. But here, nothing that goes on at the index level, a rebalance of the index, nothing of that nature will cause you to have a tax impact.
It's got a lot of Belgian dentist clients.
Here's another one that's pretty cool. This is one of those ones, if you're even cautiously optimistic on equities, this is something called a strategic accelerated return security, redemption security, and it's an auto-callable note. The difference between a callable note and an auto-callable note. An auto-callable note gets called automatically if a condition is satisfied, period. It has nothing to do with whether or not the issuing creditor has interest in redeeming their security at some level. This is if X, then Y. Right? In this case, the X happens to be if the S&P is the same as or even a single tick higher at first observation date, then the note is redeemable at, actually this one's on the Euro Stoxx 50, then it's redeemable at par plus 10%. Okay, so here's a 2-year note, callable 3 times, after 12 months, after 18 months, after 24 months. And there's actually a funny part of this, but or funny I think, geeky you'll think. So basically you look at the index after a year. If the index is higher, it's called away. You get your money back plus 10%. If the index is lower, then you keep going. Right? You look at it again after 18 months. If the index is higher, you get called away at par plus 1.5 times 10. So in other words, there's like an internal rate of return, and if you're called away at after 18 months, you're going to get 18%. Right? And then last, or in this case 15%, excuse me, so just 1.5 times the premium, which was 10. In the final observation, maturity, if it's higher, you're going to get your money back plus 2 times the premium, or 20%. If the index is lower, if it's only 10% lower, you'll get all of your money back. If it's 11% lower, you'll get your money back less 1%. And so you have 1-to-1 downside thereafter. It's another way to play equities. It's a way to play equities with a cushion. It's a way to play equities and have an attractive potential return that doesn't require the market to go up 10% for you to have a 10% return. Okay, so again, it's a cautiously optimistic. If you're directionally accurate, you can make a very nice return. The historical return of equities is about 10%. This has a buffer, right? The funny part about this is, and this is something that I was asked to do at lunch, it's like, okay, well, let's talk about how you do this stuff. Well, basically, what you as the investor are doing is you're buying, in this case, the Euro Stoxx 50, and then you're selling what is a Bermudan option. Okay? And the reason that that's funny is, does everyone in this room know what an American-style option is? Okay, it's an option that's exercisable any day of its life. A European-style option is exercisable only at one point, at maturity. A Bermudan-style option is exercisable at different points within the option's life. So here's Europe, and here's America, and Bermuda is somewhere in between. That's why they call it that. I told you it was geeky. Last but not least is probably the coolest thing that we've done in a long time, and that's Merrill Lynch has figured out how to deliver hedge fund style returns, or hedge fund beta returns, okay, without a hedge fund vehicle and in a very tax efficient and a very liquid format, using 6 very familiar investments. So effectively, if you look at, this is our friendly ETF chart, right? The passive management has steadily crept up in the long-only industry as the industry matured and as alpha has gone away. The same arguments can be made for hedge funds. We've got 7,000 hedge funds out there. Pardon me, we've got almost 8,000 hedge funds out there, and we've got $1.8 trillion in assets. Merrill, through a process that was really a regression process, looked at the HFR Composite Index. This is an index of 2,000 hedge funds that have about $400 billion in assets, which is comprised of about 37 sub-strategies, including all the ones that you know, like equity a hedge and global macro and emerging markets and event-driven and market timing and fixed income and credit strategies and all that stuff, right? You could never in your wildest imagination own all 2,000 of these hedge funds, right? But here is really the best approximation of the hedge fund universe, and it's equally weighted. What we then did is we figured out that there's got to be some way to look at the performance of this index and capture the majority of it by being allocated to a lot of the stuff that they're already allocated to. And we figured, okay, they're involved in commodities, they're involved in corporate debt, they're involved in high yield credit and equities and exotic options and currencies. What do we do? And then the best way to describe it is, think about an Excel spreadsheet, right? The independent variable is the return of this index that you could never own and perfectly replicate. That's the independent variable, and that's in this column over here. We then put a whole bunch of familiar investments into the rest of the spreadsheet as dependent variables, and we ran a big fat regression, right? Y equals mx plus b, except there's a lot more than just x. And then we looked at every single one of them that had any significance to it. And lo and behold, it turned out that we only needed about 6 of them to deliver 95% correlation to the HFR index. In other words, capture 95% of what defined the performance of this index. Now, we're not long all of these things. In fact, it changes quite dramatically what we are in these. But what we do, we created this index. What we do is we look at 24 trailing months, and we look at what the best fit was from an allocation perspective, and that is the allocation for the month forward. Okay? 1 month forward, we do it again. So it's rebalanced on a monthly basis by being either long or short the S&P 500, long or short the Russell 2000, long or short the MSCI EFA index, long or short the MSCI Emerging Market Index, long or short an index that is sort of a trade-balanced index of the U.S. dollar called the DXY. If you look on Bloomberg, it's probably the best approximation of the dollar, sort of general malaise, and 1 month LIBOR. Right? It makes a lot of sense from just like a 30,000-foot perspective, because a lot of these funds are getting levered exposure to currencies versus the dollar. A lot of these funds are using quite a bit of leverage, and as a result, a lot of their return comes from LIBOR. Small cap has a tendency to give you the small cap return, but also there's a very high correlation in the difference in the performance between the S&P 500 and the Russell 2000. Very high correlation between that and the level of credit spreads. Right? So in this, they create something that's able to deliver through these 6 model components through a dynamic model with no discretion. Right? There's rules-based. I just told you how we did it, and we tell everybody how we did it, because we don't want there to be any sort of misgivings about what this strategy is. It's designed to deliver beta. You're not buying a hedge fund, right? It's not giving you the performance of a hedge fund. It's giving you the performance of these 6 things, whether you're long or short. But it gives the client 94 to 95% correlation with the hedge fund HFRI fund-weighted composite index, which is a non-investable industry benchmark. It permits the separation of hedge fund alpha from hedge fund beta. Once again, pay what you need to pay to get the fund manager that can deliver alpha. If you still have alpha after you've paid, continue to pay. Right? The translation is avoid paying an alpha fee for beta returns. This strategy also eliminates the single manager risk, right? I had the pleasure of meeting with a hedge fund in Connecticut, and even their receptionist was smarter than I was. I mean, wildly smarter than I was. They had PhDs in everything. And the conversations we were having made me dizzy. And they're no longer there anymore because they got too smart and they decided to take a position in natural gas. It didn't go so well for them. So there is always, when you're with a single manager, an element that you need to take into consideration. The I'm smarter than the rest of the world theory, right? You eliminate single manager risk and style drift. So effectively, you're getting a hedge fund return, and it gives you the opportunity, for the same reason you would buy the Spider, you would buy this particular offering. If you look, this is the outperformance of the HFR index versus the Merrill Lynch factor model going back to 1994. Put another way, this is the alpha generated by the members of the HFR index. Back in the day, they were generating at least 120 basis points of alpha. These days, not so much, right? And I'm not taking down fund managers who deliver alpha. I'm saying that there shouldn't be 7,500 hedge funds, right? When everybody you know who is losing their job says, I'm going to go start a hedge fund, right? Or again, when they say the average hedge fund manager has $50 million in assets, and yet you know that the really big ones have tens and 20s and in some cases hundreds of billions, you know there's a lot of guys out there with $500,000 calling themselves a hedge fund and running out of the back of their car. This is a great way to give a client the exposure to the AI strategies with low cost, transparency, liquidity, and tax efficiency, right? You get the performance. Nothing that happens at the index level impacts you from a tax perspective. Your gain is only incurred when you sell the note or it matures. But there's a hell of a lot of trading that's going on. If you go back in time, now, there's no human being on the planet who could read this from that distance, but just assume that this is a very long time series. And here are the 6 underlying, right? You're whipping around. There's a heck of a lot of trading that's going on.
Weights in
Yeah, here's your current weight in the S&P. You're short the S&P. You're short the dollar. You are long MSCI EFA. You are long MSCI emerging markets. You are long Russell 2000. And you are very, very long LIBOR.
So for the benefit of people that aren't familiar with this, those weights are based on historical data. What the historical regression tells you that the average hedge fund manager today, or over the last 24 months.
Exactly. Were we to look at the last 24 months of performance of the HFR index and make that the independent variable and have only these be the 6 variables that we put in as dependent variables. Pardon me, I guess it would be the other way around. Yes, this would be the dependent variable. I got it wrong. My statistics fails me. HFR index is what you're seeking to replicate. You run a regression. The regression tells you that your, with y equals mx plus b, your m on the S&P is actually a -8. Your m on the dollar is a -2. Your m on the EFA is a +20, right, in terms of percentage terms.
I'm just wondering, for only running the regression for 24 months, how much of an inefficiency is there, or potential inefficiency is there, because there's a lag on the HFRI index?
If you were to run it once and be done, there'd be a huge inefficiency. But by virtue of the fact that we've back-tested this and the correlation is consistently 95%, 94, 95%, and by virtue of the fact that we are reallocating, and we're reallocating a lot, right? I mean, you've reversed positions in
every month?
Yes, you're reallocating on a monthly basis, or you're recalculating. And in every case, with very few exceptions, there's a lot of changes going on every month. But here, this is a strategy where the 24-month rolling period wasn't because we only had 24 months of data. We had as much data as the world knows, right? I mean, that's one thing Wall Street is never shy about, gathering data and having a database. But here, the 24-month rolling period was also the optimal.
And the
Question.
indexes you're whipping around are all so huge that you can move in and out.
Yeah, they're the most liquid things in the world. You had a question?
When you say you reallocate every month, is there a plus or minus that you don't reallocate within? If it doesn't change a whole lot, or if it changes at all, do you guys reallocate?
Yeah, I mean, quite frankly, there might be such a small move that the cost to replicate, the cost to transact might outweigh the cost to, or the benefit associated with perfect replication, but it really doesn't cost a brokerage firm anything to trade, if you think about it. If you were doing this at home, right, there might be, in the same way that you can replicate the Russell 2000 by owning about 1,500 stocks. You can replicate this and you don't have to perfectly mirror it. But if we're delivering this to a client, or if we're promising to pay the client this at maturity, we might as well just own it. If we're going to make bets, we can make bets in another way.
You probably use derivative contracts for much of that exposure, right? Forwards.
Yeah, I mean, every single one of these things has futures on it.
Yeah.
So in fact, we're earning...
So to answer your question, isn't like you're buying all 2,000 names?
Yeah, oh, absolutely not. And notice, I keep comparing it to this thing that you can't own, the HFRI Composite Index. If you look at it, if you look at it going back a very, very, very long period, the annualized return, because it used to generate alpha, right? Hedge fund managers had a much greater propensity to generate alpha. The annualized return is actually higher, and that's great, right? Except you can't own it, right? So this thing that we've created has an annualized return of about 9.5%. The return in 2006 was only slightly lower than the return on the index. But what I love to look at, and depending on the audience, I either refer to it as the information ratio, or I call it the bang for the buck meter, right? Your information ratio here, 12% with a 4% annualized volatility. Okay, versus, let's think about equities. S&P 500, your annualized return is about 10%. Your annualized volatility is about 16%. Right? Look at, you're getting a better than equity return with a quarter of the risk. Or if you want to think about it in risk return or information ratio, you're getting 3 units of return per unit of risk that you're taking. 3 units of bang for every buck that you're paying. Right? It's just, in my mind, it's a very, very compelling strategy. And also, because the next nearest thing that you can actually buy is so incredibly inferior in terms of the performance. Right? The HFR Global Investable Index, where they cull it down to a much smaller universe of funds, and they say, no, this is the investable index. Well, apparently the investable ones suck, right? And you get only a shade over 2 units of return for every unit of risk you're taking. And here, I mean, just in terms of annualized returns and bang for the buck, everything else seems to me to be very much inferior. And by the way that you would own any of these others is through a fund of funds. And a fund of funds has not only the hedge fund manager fee built in, but also has a fund of funds manager fee built in, which is an additional 1 or 2% plus an incremental 10% of the performance. So effectively, you're paying away 3 and 30, or 3.5 or 4 and 30 or more. When you start splitting up your performance that much, you don't have a lot of performance when you're done. And it is truly a non-correlated asset if you look at it in many regards. In terms of its correlation to high yield, it's got a correlation of about 50. Correlation to commodities, about 20. It's rather highly correlated to the equity markets, but in terms of the risk return, it's far superior. And obviously, it's extraordinarily correlated to the index it's supposed to replicate. In terms of performance, the only thing that's better is the thing you can't own, right? Unless you can actually go out and buy 2,000 hedge funds, and if you can, I'm willing to be adopted. This is some other staggeringly boring statistics. This is how we're going to deliver it to our clients. It's a Merrill Lynch note. It can be issued by anybody, but in this case, it's a Merrill Lynch note. It has a 5-year maturity. Client buys it, holds it for 5 years. They don't pay a single tax bill. The only cost is there's a 1% selling concession up front, and there's a 1% annual fee that's taken out of the net asset value. So effectively, you give me $10, you get $9.90 invested, and then every year, your NAV will be reduced by 1%. But history tells us that you'll grow it somewhere between 9 and 11%, and you'll have a hell of a lot less volatility than you would otherwise have if you were owning an asset class like equities, which gives you that type of return. Now, here are some risk factors, and here are some disclaimers. I'll allow you to commit those to memory. But, I mean, I really appreciate the time, and I know that Huey and I are honored to be here, and we think that this school has come a long way. We're grateful to the school in a lot of ways, but we also think, speaking for myself, I couldn't get in again. I told you that at the beginning, but when I was looking at the GPAs of the guys I had lunch with, I was like, I don't think they've gotten easier in grading, have they? Their GPA was multiple of mine. But I just think that, the entire crux of my presentation, I hope you understand that I like what I do, right? It's fascinating to me, and I think it's really cool. So my advice to you is find something that you like to do, because you're going to do a lot of it, right? You're going to spend the majority of your waking hours doing it. And so find something that jazzes you up, because then it doesn't feel quite as much like work.